Welcome to the KBRA Quarterly Bank Compendium Podcast. I'm Brian Ropp, Senior Director in the Financial Institutions Group, and I'm joined by John Rempe, Director in the Financial Institutions Group. We appreciate that you're joining us to hear our key themes in bank credit from the third quarter compendium. A possible title for this podcast would be To Expect Higher Quality Earnings Going Forward, because the significant non-core items have mostly run their course. So, John, what are the top 3 points we will be digging into for this quarter's podcast?
So, Brian, we're going to be talking about themes that aren't necessarily new this quarter, but some that may be at their inflection points, and we'll elaborate on what that means. So here are the 3 key points. First is liquidity and net interest margin and our expectations moving forward. Second is the combination of strong credit quality and slower loan growth has driven reserve releases, which is beginning to moderate. And third, with non-core earnings running their course, we expect higher quality earnings moving forward. And I'll go ahead and take the first point, if you don't mind, Brian, which is liquidity and net interest margin. As many of you know, we already kind of discussed this last quarter. It's been more of the same in the third quarter. The loan to deposit ratio continues to trend lower with a median of 73% for KBRA rated banks, which was down 200 basis points quarter over quarter. And this was in spite of rather solid loan growth too, with median loan growth of 8% on an annualized basis, which compares favorably to Fed data among all banks, which was just above 2%. And this was due to continued deposit inflows, with the KBRA rated universe reporting an average of 12% annualized deposit growth, which also outpaced the Fed's average at 9%. Looking at the balance sheet composition, loans to total assets stayed flat at a very low 61%. While investment securities increased to 18% of total assets compared to 17% the prior quarter. And cash balances increased slightly, but have largely stabilized as banks wait for a better interest rate environment to deploy liquidity. Unfortunately, that didn't really transpire in the third quarter, with the 10-year Treasury yield decreasing at first, though rebounded to exceed 150 by quarter end. So now let's talk about how this excess liquidity impacted net interest margins. The median NIM for KBRA rated banks was flat sequentially at 3.22%. While we don't know for sure how much PPP fee income impacted margins for the quarter, from most of the bank's earnings call, it seemed to add in between 10 to 20 basis points to net interest margin in recent quarters. With that said, with PPP balances continuing to decline, just around 3% of total loans now at the end of the third quarter, we expect NIM pressure to continue to decline as reported NIMs are expected to start to bridge the gap with core NIM, with PPP fee income starting to fade. However, this is barring any changes with rates or meaningful loan growth that results in changes in the earning asset mix, which we don't expect in the near term. Lastly, the median cost of deposits was down to 18 basis points for the quarter, and most banks have positioned their balance sheets to be asset sensitive, but they'll need a remixing of earning assets to generate NIM expansion that would include excess liquidity, funding loan growth over investment securities. So, Brian, you did some analysis on our coverage universe and how their deposit costs have trended. What did you discover from that?
So thanks, John. So first, we took a look at the median cost of deposits for the fourth quarter of 2019, which we felt reflected pre-pandemic liquidity levels, but it also had some influence from the first 75 basis points of Fed fund cuts. So the median for this time frame for our coverage universe was 92 basis points. So then if you fast forward to the third quarter of 2021, so 7 quarters later, also another 150 basis point cuts in Fed funds later, the KBRA median cost of deposits declined to just 18 basis points. So the cost of deposits dropped a total of 74 basis points during this time frame. So if you go back to the fourth quarter 2019 data and you bifurcate it between those that went above the median and those that go below, so essentially what we would view as those that are higher cost or lower cost and those that are, say, liability sensitive and asset sensitive, the median high cost was 119 basis points, while the median low cost was only 73 basis points. So if you compare these differences between the high and the low cost between fourth quarter 2019 and the third quarter of 2021, the gap has collapsed to just 14 basis points. So our takeaway essentially is But banks with strong deposit franchises have lost their pricing competitive advantage to weaker funded banks. With non-interest bearing deposits accounting for a large portion of the deposit growth that the industry's experienced, we expect these pricing dynamics to continue for a period of time as interest rates begin to rise and the excess liquidity begins to get deployed. So lastly, with cost of deposits hitting what we view as kind of natural floor levels across most of the industry, we expect very limited improvements going forward, which means banks will ultimately need loan growth for net interest margin expansion to replace higher yielding loan runoff. So John, now that we've covered what we are seeing with net interest margins and excess liquidity, let's move on to another item that has also played a large role in earnings performance in 2021, credit quality and reserve releases. What are your thoughts on the KBRA public bank universe for credit quality and reserve recaptures, and how do you see this playing out over the next several quarters?
Yeah, thanks, Brian. So just looking at credit quality metrics, they've remained very sound. In fact, the NPA ratio has reached its lowest level at 51 basis points since the start of the pandemic. Meanwhile, net charge-offs have been nominal as well, which were flat quarter over quarter at 3 basis points. So given this, most banks have released reserve for the quarter, as previously noted. Other credit quality trends, loan deferrals are largely finished, with most banks reporting less than 1% of loans on a deferral of some sort, and many banks with really none remaining. And despite this, loan risk ratings continue to trend positively. Both criticized and classified loan levels continue to trend lower for most of our banks. So it appears that the massive amounts of PPP and deferral periods have done their jobs. However, we do credit the bank teams as well for their conservative underwriting and constant monitoring of borrowers.
Well, thanks, John. So that's a great recap on the credit quality and expectations for reserve releases going forward. I think that's a great segue, though, into what bank earnings have been, in many cases, materially impacted by non-core items, and they're running their course, so to speak. So to be clear, the key non-core items include mortgage banking. So we've had record levels in 2020, and that continued into strong tailwinds into the 2021, although we are seeing volumes approaching what we term as normalized levels, as well as the stabilization in the gain on sales. Also, we've had round one PPP loan balances that have been largely forgiven to this point, and the associated PPP fee income has been recognized and realized into interest income. So the large impact from PPP fee income it's had on net interest margins has been as high as 15 to 25 basis points in some instances. So we do expect to see PPP fee income being recognized going forward, but to a much smaller degree. And then lastly, provision recaptures and releases is also another non-core item that has, in many cases, had a significant impact on return on average assets in the 3 quarters of 2021. But the KBRA median loan loss reserve is just 7 basis points within the first quarter 2020 levels, which reflected the CECL adoption for pretty much 2/3 of our bank universe. We should note that while banks were taking large releases in the first 3 quarters of 2021, there was only modest loan growth, and many banks experienced negative loan growth due to the headwinds of PPP loan forgiveness. So with loan pipelines increasing in the 3rd quarter and PPP impacts diminishing, we expect loan balances to begin to grow in the low to mid single-digit range for many of the KBRA covered banks, which will draw positive loan provisioning going forward. So in conclusion, we expect to see the impact from non-core earnings enhancements to diminish, creating even stronger focus on loan growth and net interest margin expansion. In a low growth environment, we believe that M&A will continue to be elevated as credit quality remains strong, industry has solid capital levels, and the need to deploy excess liquidity into higher earning assets along with core earnings performance will gain even more intense focus. So with that, I'll turn it back to John for the last words.
Well, listeners, that's a wrap for our 3rd quarter Bank Compendium podcast. Hope you found it to be useful. Brian, thanks for having me, and we look forward to speaking with everyone again next quarter. Have a nice day.
Thank you.
And as always, for access to KBRA ratings and research, go to kbra.com.